This video is based on investment appraisal and it's looking at average rate of return. So what average rate of return does, it assesses the worth of an investment by calculating the average annual profit as a percentage of the investment, the initial investment. So what it does is, it looks at whether the investment is worth it. It looks at the return of that investment. If the return from the investment is not very high, then again, the company might feel that it's not in their best interest to go ahead with the investment. However, if the rate of return is quite high on that investment and they're expecting the investment to create a lot of profit, then they'll go ahead with the investment. So there's a step-by-step guide as to how to do it. So number one, what you do is you calculate the average annual profit by adding up all the net cash flows divided by the number of years. So again, they'll give you this data and they'll give you these figures in terms of sales, revenue and profits. And all you do is just literally do a cumulative profit. And then once you've done that, you divide the average annual profits by the initial investment, and it's expressed as a percentage. So the formula is, obviously you can see below, average annual profits, all the net cash flow, divided by the initial capital cost times by 100. So if we have a look at this example, just to put it into practice, if we see from year 0 to year 4, and we work out what the profit is, we can see that in year 1 to year 4 that we make a profit of 9 million. But we also have to remember the initial investment. So the profit of the 4 years, which is 9 million, minus the 5 million, and we get the profit of 4 million. So to start off with, what we've got is 4 million for the profit. And then, what is the lifespan? Well, the lifespan we can see is 4 years because it's given us the 4 years of data. And again, they'll give you this in the case study. So what we do is we'll do a 4 million divided by 4 years, and we'll get a 1 million annual profit from that. And then what we do is we go to step 3, and we get our 1 million. Which again we calculated in step 2, and we divide that by the initial investment of 5 million, and we times it by 100, remember, to get a percentage, and we get 20%. So again, 20% is the average rate of return. Now, is that high or is that low? I think that completely depends. It depends on the expectation of the investment. It depends maybe on the forecast. It depends on industry average, maybe for a similar type of investment. It depends on other options that you could possibly invest in. You'll get that information from the case study, and you'll be able to compare it with whatever it is within the case study. So again, this is the example just shown via the answers, and if you follow these steps, then again you'll find the average rate of return pretty straightforward. Right, so let's have a look at a past paper. This is from the old AQA specification. I've already done a video on payback period, and we had a look at this question. But now what we're going to do is the average rate of return to get the other 4 marks. So what you can do is you can pause the video, you can have a look at the data, and you can have a go at calculating it yourself, and then I will go through the calculations and we'll look at the mark scheme as well. So what you do to start off with, you calculate the profit. So if you do your 2.4 million, if we see just here, added onto your 3 million, added to your 4 million and your 5.8 million, and you'll get 15.2 million. However, don't forget, you've got also your conversion cost of 10 million. So you subtract that from 15.2 million and you'll get a return of 5.2 million from this investment. However, we need to work out the average rate of return. So what you do is you get your 5.2 million and you find out how many years. So we can see that it's years 1, 2, 3, 4. So we've got 4 years. So you 5.2 million divided by 4 and you get 1.3. You do your 1.3 once you've got that. So your 1.3 and you divide it by the initial investment again, which is 10 million. So your 1.3 divided by 10 and then you times it by 100 to get a percentage and you'll get 13%. So if we check the mark scheme, we can see that we've got the 13% there. Yeah, there you go. So we get our 4 marks.